Hey everyone, thanks for joining us. Today we're talking about a very important and relevant topic for investors, and that is this whole higher for longer phenomenon. Everyone's wondering, how are high interest rates going to impact the economy, including corporations and financial markets? Is it all bad news, or are there benefits to the current environment that we find ourselves in? Additionally, how should investors position their portfolios given everything that's going on? We're going to be answering all of those questions and more with the help of two experts from GlobalX, Jon Maier, who's the Chief Investment Officer at the firm, and Michelle Cluver, who is a Senior Portfolio Strategist at GlobalX. Jon, Michelle, thanks so much for being here. Jon, I want to start by asking you about this idea that interest rates are going to stay higher for longer. That narrative has really taken hold in the markets. As a lot of people listening know, bond yields have shot up through the roof over the past few months. What's your take on everything going on with yields? And what do you think the Fed is going to say and do over the next few months?
Sure. Thanks, Amit. And first of all, let me introduce myself. I'm Jon Maier. I'm the Chief Investment Officer of GlobalX. GlobalX is an ETF provider. We have ETFs, so we have model portfolios. We provide macro research. In this call, we're providing a good amount of macro research and providing information about some of the themes within some of our portfolios. To answer your question, I want to do a little recap. And certainly the markets really have been rate driven. In September, stocks declined as the Fed signaled that interest rates could remain higher for longer, certainly roiled markets. Also, the rise in the August CPI boosted by higher energy prices also supported the Fed's message on interest rate needing to remain higher for longer for an extended period of time. Again, spooking markets. So reduced expectations of future rate cuts also weighed on equity markets. So the S&P 500 in September was down close to 5%. The NASDAQ was down close to 6%. Still holding on gains for the year. Small cap stocks underperformed in both September and in the third quarter. And cyclical and interest rate sensitive sectors generally underperformed the S&P 500, while energy sector benefited from rising oil prices. Oil prices have pulled back a little bit. The producer price index increased 0.5% for September against an estimate of 0.3% rise. And much of the increase had to do with finished goods. So inflation is still a concern in the market. And turning over to treasury yields, the treasury yield curve steepened, mostly seen on the long end as markets reduced their hopes of a soft landing. Markets have been expecting more recently a soft landing, but there have been certain signs that there's some cracks in the consumer, but we have been hearing that for quite some time. We saw a sharp and fast rise in yields, as Amit mentioned, an extreme bearish positioning in treasury futures. And I think this has led to a more recent decline in yields, which has buoyed markets in recent days. Remember that we're near the end of an aggressive rate hiking cycle, we believe, which could limit upside in yields. And we're already seeing some of the declines in yields over the past few trading days. Longer term, with the 10-year treasury yield holding above its long-term average of 4.5%, this could keep us in a higher yield environment relative to the previous QE era of historically low yields. Also, some of the geopolitical events could potentially cause a move to safety coming off peak levels. And the Fed has indicated that higher rates for longer are very possible, and that potentially could weigh on markets near term. So there's no way to get around it. The Fed plays a crucial and central role in the conversation and the movement in both equity and fixed income markets. Michelle, labor market tightness has certainly played a large role in the continued resilience of the U.S. economy. In September's payrolls were off the charts. Any thoughts on the labor market currently?
Yeah, thanks, Jon. The tightness of the labor market has certainly supported higher levels of discretionary spending and travel. This is something that's been really supporting economic growth within the US on the consumption side over the last 2 years. And while we've seen some moderation in job gains relative to 2 years ago, September's non-farm payrolls were off the chart, as John was mentioning, coming in at 336,000. This was more than double the market expectations and reflects a monthly gain that was well above the 267,000 monthly run rate from the prior 12 months. Additionally, JOLTS job openings for August surpassed expectations, rising by 9.6 million job openings, while the number of job openings remains well above the number of unemployed people available to fill positions. This ratio is starting to moderate, but continues to reflect underlying economic strength. The strength in both these data points really reflects the two narratives that are dominating market sentiment. On the one hand, as John was discussing earlier, the continued economic strength resulting in policy yields needing to remain higher for longer. But on the other hand, there were also elements that the market liked about the potential Goldilocks scenario reflected in the data. Wage inflation pressures moderated. Average hourly earnings came in below expectations, despite this really strong headline figure. Additionally, the large upward revision to July and August non-farm payrolls reversed a trend in downward revisions that had been concerning markets about the underlying strength in the US economy. Labor market strength certainly has been a factor that's contributed to the resilience of the US economy, but it's also worth keeping in mind that the US consumer and companies were really well prepared for higher interest rates during this cycle. John, could you give us a bit more color on balance sheets and how this impacts economic resilience in a higher for longer environment?
Of course. Thanks, Michelle. So financial obligations as a share of disposable income remains well below historical levels, as you can see in the chart on the top right. What this really means is that the household balance sheet is pretty strong, despite a recent uptick over the past year or so. What you do notice in the chart that over a longer period of time, we've seen a deleveraging since 2008. Households have entered this cycle much, much stronger than the previous cycle. Now, why is that? Let's look at some of the market dynamics. Mortgage rates. We know the most popular mortgage instrument is a 30-year fixed rate mortgage. We know that a lot of people locked in the plus or minus 3% range. So what that means is that households have kept their interest expense down on their home purchase. Also, home prices haven't declined. So the consumer feels wealthier. And while we are seeing that credit card balances are increasing and credit card rates are very high, about 25% or so or more in some instances, the consumer has the opportunity potentially to tap some of their home equity line if they have to at a much lower rate than their credit card rate. So the consumer is feeling pretty good, despite the fact that interest rates have moved up a lot, but it's not affecting them directly at the moment. Now, there are certain factors that could start chipping away at the health of the consumer. We know that student loan repayments just began, and that's going to ramp up, and that potentially could impact the spending power of the consumer. As mentioned, we know credit card balances are increasing. We know auto loan rates are higher. That potentially could impact the consumer as well. But we've been talking about a lot of this for the past 15 to 18 months. But what it is converging upon is that Fed policy lags about 15 to 18 months. So we could be at that juncture right now where the higher interest rate expense on other items besides homes could be impacting the consumer. We also know that it's harder to access credit right now. Financial conditions are certainly tightening. They were never that loose, but they're certainly tightening. We'll get a better sense of that over the coming weeks when banks report earnings. So All of that leads me to believe that it's possible that the consumer is at a tipping point, even though the health of the consumer, the balance sheet, is pretty good. So, Michelle, consumer resilience has been just one pillar holding up the economy. Year to date, we've seen high levels of capex, which is good, and fixed income investment is helping to boost economic growth. So, what are your views on U.S. economic growth and the resilience of the U.S. economy going into the end of the year?
That's a great question. Economic growth expectations have certainly shifted a lot this year. The strength of the labor market combined with those really solid balance sheets that you're mentioning have certainly helped delay the impact of higher interest rates. As such, this long and variable lag in the effectiveness of monetary policy may have actually become even longer. Currently, the US economy is on track to grow just over 2% in 2023 before slowing in 2024. Looking at the contribution to real GDP thus far in 2023, we're seeing strength in two key areas, consumption and fixed investment. Given the importance of consumption to the US economy, the resilience in this area has really underpinned the upward revisions to 2023 economic growth. After growing at just over 2% in the first half, real US GDP growth is expected to actually accelerate into the third quarter before potentially slowing down in the final quarter. GDP Now is currently expecting Q3 GDP growth to be 5.1%. At the beginning of October, we saw a slight uptick in this forecast as the strength of the labor market surprised to the upside. Generally, this is reflecting the strong underlying consumer data that we saw throughout the quarter. However, while the consumer remained resilient, excess savings are diminishing. And as John mentioned, student loan repayments are resuming. Wage inflation is not keeping pace with inflation. Balance sheets are starting to deteriorate. And there has also been an uptick in WARN notifications, potentially indicating that there are starting to be some cracks showing in the labor market. These are all factors that could dampen consumer growth in the final stretch of 2023 and into the first half of 2024. But while consumption could slow, government spending remains a bright spot. During the second quarter, we saw the impact of higher fiscal support contributing to an acceleration in fixed investments. The Infrastructure Investment and Jobs Act, Inflation Reduction Act, and CHIPS Act and Science Act all provided support to improve US infrastructure and provide manufacturing incentives to boost investment in areas that are strategically important. These acts will provide funding over the coming decades. As such, fixed investment is likely to remain a supportive area to economic growth, even if the consumer faces headwinds in early 2024.
You mentioned that fiscal support is an area that contributed to higher levels of fixed investment. Could you give us a little bit more color on the level of fiscal support being provided and how is that impacting CapEx?
Sure. The Infrastructure Investment and Jobs Act was passed in July 2021. This includes $550 billion in new federal investment in infrastructure projects, ranging from hard infrastructure projects, such as improving roads, bridges, airports, and water infrastructure, all the way to digital infrastructure, such as improving internet access. It also includes some funding for clean energy infrastructure, such as a network of EV charging stations along major highways. Of this $550 billion, thus far, there have been around $220 billion in announced deals. When thinking about infrastructure, it's a slow process from funding to reaping the rewards from the investment. There's a high level of planning that goes into each infrastructure project. As such, spending will be spread over 5 to 10 years. Consequently, this fiscal support is likely to provide a tailwind to economic growth for multiple years. While there's a lot that could be said on how the money will be allocated and the projects that are underway, I want to also provide some high-level information on the other two acts, as they all really work together to increase fixed investment in the US. The Inflation Reduction Act was passed in August 2022, and building on the Infrastructure Investment and Jobs Act, this act focuses on climate goals, improves energy security, and reducing energy and healthcare costs. At the same time, the CHIPS and Science Act was also passed in August 2022, and it provides around $280 billion in new funding to boost domestic research and manufacturing of semiconductors. This was structured as funding for R&D as well as manufacturing incentives. As artificial intelligence grows in importance, so do the chips that power their models. The CHIPS Act focuses on solidifying the US's leadership in the technology of the future, be they disruptive technologies or technologies related to energy transition. All three of these acts really work together to encourage companies in strategically important areas to invest and grow their operations within the US. This has occurred at the same time that an increasing number of companies are rethinking supply chains after multiple years of disruption. Reshoring and nearshoring is a growing trend, and infrastructure improvements can help improve the competitiveness of manufacturing in the US. Additionally, after decades of underinvestment, US companies are increasing CapEx spending. These are all factors driving up fixed investment. In line with that, looking at the chart on the bottom left, there's been a dramatic shift in manufacturing construction spending. These three acts together have helped encourage more than $500 billion in private sector manufacturing since 2021, of which $240 billion has focused on clean energy manufacturing. There's been so many great examples of how funding from these acts is being used to upgrade US physical infrastructure while also making plenty of investments that stand to benefit from the growing trend in EVs and clean energy solutions. John, could you provide some interesting examples of how this funding is being spent?
Sure. Thanks, Michelle. And to reiterate a point that Michelle made, the three fiscal packages really work together, and they're important for building our infrastructure, both from the ground level to our digital infrastructure. Now, the Inflation Reduction Act is an investment in combating climate change, providing around $370 billion to bolster sustainability efforts, increase energy security, and lower energy cost. Now, a little bit of a misnomer is that it's $370 billion. It's actually could be much more than that. The Inflation Reduction Act is not capped. So a huge part of the act is uncapped spending. So the more people who buy a car or build a factory or take advantage of these incentives, the more spending will occur. And also the tangential private sector spending that occurs when you have a fiscal package like this could be as much as 10 to 1. So it's very powerful. At the same time, intersecting with this very strong CapEx cycle that we're experiencing right now for S&P 500 companies. And not to get political, and I won't get political, but it's very interesting that a lot of the dollars that are flowing into some of the Republican-led states, which have exposure to energy, they're steering money towards fossil fuel states because of the need for greening of the economy, because that has to occur on a long-term basis all over the country. So we are seeing that happen. But if you look at some of the more specific areas that money is being spent, first you have to remember that projects must undergo an extensive planning and review period. Now, this could take a while, but once spending is authorized, disbursements begin over several years, which really could create a strong runway for the infrastructure theme to perform well. And we're really just in the early innings of the spending of these infrastructure packages. So just remember that. Examples of some current projects are the Denver International Airport expansion. And I remember when it was being built for the first time. But $59 million has been allocated with an estimated total cost of $1.2 billion through 2028. So again, just the early stages of this project. Second, there's the Houston Ship Channel project expansion, which is due to increased volumes, $1 billion with an estimated 2025 project delivery. So we're a little closer to that one. Then there's the Penn Station Access in New York, which is expected total cost of close to $3 billion over the next 3 to 5 years. And then there's the Hudson Tunnel project in New York and New Jersey, which after decades of delays, the project is finally underway. This is thanks to the federal investments in the Jobs Act. And $7 billion was secured with the expected conclusion in 2035. So a long tail project is going to take a long time. but it's really important for the economic health of the tri-state area. So these projects are really necessary for the US to stay competitive. And you have to realize that the nature of the projects are long tail. So the fiscal spending occurs, and then the private sector spending also occurs, and tax credits on top of that for different areas.
Just adding on to what you're saying, as someone who makes use of NJ Transit, I'm definitely looking forward to the upgrades and fewer signal issues. So there's certainly, while infrastructure takes a long time to actually reap the rewards, I'm certainly looking forward to when it does see improvements, and the longer term economic benefits will be huge.
I can imagine these projects sound very useful and very massive as well. But Michelle, from an investor standpoint, how should advisors think about infrastructure investment? And how does it fit within the context of an investing for a higher for longer environment, that same environment we've been talking about up until now?
Thanks, Sumit. Just taking a step back to explain the investment universe, using common equities, investors can actually gain exposure to the accelerated interest in US infrastructure spending through investing in a basket of companies that benefit from increased spending on infrastructure projects. This includes the production of raw materials, heavy equipment, construction, and engineering companies. Now, if we look at this basket of companies in the context of the current market environment, markets are currently facing two competing narratives: higher for longer yields and the potential for a Goldilocks scenario with a soft landing. If we're starting with a higher for longer scenario, under this case, market resilience is what keeps the pressure on yields. Economic resilience has the potential to support continued investment and CapEx spending. However, should private investment and consumption slow or decline as higher yields start to bite, the space continues to benefit from government spending due to improving aging infrastructure. And moving across to the Goldilocks scenario, higher yields reduces excess demand without causing a recession. Hopefully something like this could happen. We'll yet to see. Under this scenario, these infrastructure companies continue to stand to benefit from fiscal support while also having better than expected economic activity, boosting more cyclical areas. Overall, this is one of the few areas that's well positioned regardless of the type of landing that the economy actually has. However, everything in portfolio management, it should be viewed within the context of a balanced portfolio.
So, John, one thing I keep hearing about is this push to reshore and nearshore manufacturing, both in the US as well as, many other countries as well. It seems to me that, things like robotics and AI are going to be key areas that are going to benefit from that trend. But it's my understanding that there's several other themes that also have structural tailwinds to adoption. Could you give us a bit more color on how you're thinking about themes within the current market environment?
Sure, and that's a great question. And I think I'd be remiss if I didn't talk about AI and how AI intersects with cloud computing and cybersecurity. Now, AI came on the scene just about a year ago in terms of public use, easy access for the consumer to really understand AI and potential benefits of AI. So what we're all hearing about is generative AI models created in the early 2000s, but leading to the birth of ChatGPT. This is a big market enterprise with some big companies involved that we know and use regularly. So it became a lot more relatable. And OpenAI already expects ChatGPT revenues to top $1 billion this year. And AI-powered subscription tools could expand the market for SaaS, software as a service application, in a meaningful way. And robotics will accelerate the shift to smart manufacturing, focusing on automation and productivity. And then cybersecurity is a common thread given the use of data across these platforms. But taking a step back, the reason that we saw the Magnificent Seven do very well particularly in the first half of this year, is because what they have is they have access to data. Data is this very expensive, hard to procure commodity that's necessary for generative AI. And since many of these companies already had the data, they really benefited from the tailwinds. But what data is like, where do you store this data? Data is stored in the cloud. Thus, cloud companies certainly will will continue to benefit from the need for the storage of ever increasing amounts of data. AI is iterative, so data essentially feeds on itself. So there's more requirements for the storage of data, and obviously the overall protection of data. But AI, again, intersects with the CapEx cycle, because right now we're in a very, very strong CapEx cycle, not seen in decades, in a period of time where earnings have weakened. So that's very unusual. And that's one of the reasons the markets have held up reasonably well this year. But if you think about and trying to relate AI and how it could increase the efficiency of an organization or an individual's work, how can AI help individual areas? So let's look at some different professions, for example. Let's look at the law. Well, AI can help augment the abilities of paralegals to do their jobs. It can help them reduce the time spent on manual tasks, freeing up more time to devote to relationship building and client-focused activities. It can help write briefs for judges and lawyers alike. Moving over to the medical profession, it can help determine better treatment and manage diseases for patients, and it allows doctors to spend more time with patients. AI can also help improve the efficiency in production lines to increase robotic technology. Because again, I mentioned that it's iterative, so it's important. The more data points will help make a better use of and efficiency of automation. And then there's so many different areas that I could go into and talk about how AI is potentially going to improve and augment the way we operate. Now, a lot of people talk that AI is going to take away our jobs. I believe it's going to enhance our jobs. It's going to provide opportunities for humans to be more efficient. So the key is that we're going to be working with AI. Now, generative AI in particular, needs human inputs. So you can't you can't remove the human, because the human is the input, but it can certainly increase our overall efficiency. And I think you are going to see that over time, that AI is going to help businesses improve. It's going to help individuals. And the one commodity that we have that we can never get back once it's used is time. And AI is going to help us manage our time.
John, I want to follow up on what you said about AI. Obviously, the technology is incredibly powerful and the hype behind it is real. But have we seen any impact on AI on corporate bottom lines yet, or is that going to take a while to happen?
To me, that's a really good question. And I want to share, I just returned from this conference called Code. It was put on by Vox Media, and I had the opportunity to listen to some corporate leaders, from the the CEO of Rivian, to the CEO of AMD, to the CEO of Warner Music. I keep saying CEO because I just had this fortunate opportunity to hear how AI is gonna impact their business. So the first part of your question, is it impacting bottom lines yet? The simple answer is no. Well, the simple answer is no, but companies are spending on AI, so that certainly impacts the bottom line. Is it increasing efficiencies yet? It's starting to. And it's going to continue in ways that we're not fully aware of. For example, Rivian, they're a I'm giving some examples from this conference. Rivian is a automaker, a truck maker, a charging company, a data company. And so their plans are going way beyond just making simple cars. Their plans are to increase the user experience. And how do you increase the user experience? By data, improving the sensor capabilities, the self-driving capabilities of the future. And it's all reliant on data and the synthesization of data. And again, I mentioned earlier that it's iterative. So many of these companies are not just doing one thing. They're starting with a product, but they're building upon that product an overall user experience that's related to data. And that brings in the whole generative AI. I listened to Lisa Su talk about the products that AMD is going to come out with and the potential competition for NVIDIA. It's certainly very important for the GPU market. One of the interesting questions was to the CEO of Warner Music, was generative AI going to create a Grammy song? And unequivocally, he said yes. Now, the question is, who has the copyright for that song? This goes back to the question earlier, or the discussion earlier about, will AI take away our jobs? AI is going to enhance our jobs. AI is reliant on human inputs. And while it's going to change things, if we don't work with AI, that's when individuals will lose their jobs. So it's important to keep up with current technology. You think about the smartphone. It's very difficult to operate in this world without having a smartphone. 15 years ago, virtually no one had smartphones 15 years ago. It was about that when it started. It's going to be something similar with AI, but a lot quicker. These adoption cycles happen a lot quicker. So will it affect the bottom line? Absolutely. Has it happened yet? Well, the spending's happened. It's starting to happen. So that certainly impacts the bottom line. But I think it's very important. And every company is thinking, how am I going to build AI into my business model? How am I going to improve efficiency? Not because they want to, they should want to, because they're going to have to.
Thanks, John. That's great color. You talked about some really important themes there. You talked about AI, cybersecurity, the cloud, robotics. How do you think about those themes in a portfolio context?
So what we do at GlobalX is we build models, or my team builds model portfolios. And one of the models that we have is a thematic model. And when we think about thematics, we think about what's going to be different next time. What's going to disrupt a particular sector over the next 5 to 10 years? What's going to disrupt financials? What's going to disrupt industrials? What's going to just disrupt technology overall? Now, there's many different themes out there, whether it be financial technology or AI or cloud computing or the Internet of Things or genomics, to name a few. Now, when we think about putting different themes together, we want to have a small amount of overlap amongst different themes. Certain companies may be in more than one theme. We also want to have a small amount of overlap across sectors. And we want to have a cross-section of sectors in this kind of broader portfolio. So it provides some inherent diversification, which we think is really important. Now, thematic investing crosses geographic regions. It's both US, Europe, Asia, and it's important to provide exposure to all of those areas. And it's important to provide exposure to intersecting themes. So I talked a little bit about how AI, which is very heavily reliant on data, is also reliant on other things like the storage of that data, the protection of that data. So the ecosystem of AI, cloud computing, and cybersecurity is really important. AI is certainly going to feed into many different areas and improve efficiencies. And so it's going to cross many different themes and sectors. And that's certainly the theme of 2023 is AI. But what we're trying to do is bring sectors together in a diversified way with the expectation that this is only a portion of your overall portfolio. Thematic investing is a momentum growth-driven strategy, so it should be thought of as such. And when you're putting into a larger portfolio, how much risk do I want to take in a broader portfolio? In a moderate portfolio, do I want to just marginally uptick my standard deviation tracking error? If that's the case, we have a suggested allocation where you're going to be exposed to these innovative themes that we think are important. And it doesn't add a meaningful amount of risk to your overall portfolio.
So, Michelle, we've talked about a lot of different ideas throughout this discussion. Do you have any insights on how investors can incorporate all of these ideas within their broader portfolios?
Yeah, so actually building on what John was just mentioning about the levels within a moderate portfolio, we really do believe that thematic equity is best utilized within the context of a balanced total portfolio, because thematic equity really provides that targeted exposure to select high growth market opportunities. It's also all cap and global in nature. And these exposures can make the portfolio more volatile than the broader market in select market environments. However, it also does reduce the overlap with broad US or international beta exposure. As such, thematic equity is really well suited to being a satellite exposure within a broader asset allocation portfolio. Within our Global X suite of portfolios, the Equity Thematic Disruptors portfolio is used as a satellite exposure within our core series portfolios. Within our conservative and moderately conservative portfolios, there's a small amount of exposure to select key themes, while in the moderate to aggressive portfolios, we actually provide a scaled version of our thematic portfolio within the broader asset allocation portfolios. Those portfolios actually also include a dedicated sleeve towards infrastructure investments. When including thematic equity in a portfolio, we believe it's really best practices to set maximum limits on the exposure based on a portfolio's risk profile. In a conservative risk profile, a tiny amount of thematic equity can offer diversification benefits. While in an aggressive risk profile, thematic equity can be a larger portion of a portfolio's overall equity due to it being in line with the risk profile's typical objective of maximizing long-term returns. In our core series portfolio, our maximum limits on thematic equity ranges from 3% in a conservative portfolio to 10% in a moderate portfolio and 25% in aggressive. This sets the maximum limit where the allocation would set during periods that are highly favorable for thematic investing. But exposure to thematic investing will adjust based on the market environment. When setting the limits on thematic equity, we're mindful of both the objectives of that specific risk profile and the impacts of different levels of thematic equity has on the portfolio's risk metrics. We understand that most investors already have a core strategy that they use. As such, we repeat the scaling exercise using a very generic asset allocation based on BlackRock's models to give an easy indication of the generally suitable maximum limits on the level of thematic equity that makes sense in a broad asset allocation. In a conservative portfolio, 10 to 20% of the portfolio's equity, or around 2 to 4% of the overall portfolio, is typically a good limit. This increases to about 6 to 12% of a portfolio for the moderate profile and 16 to 24% for an aggressive profile. These levels are selected due to this being the maximum point at which the inclusion of thematic equity has a minimal impact on both standard deviation and tracking error. I'd use ranges when expressing those limits. This is due to two key variables. Firstly, the ability to adjust the rest of the asset allocation as thematic equity is added so as to maintain the same level of overall equity. Additionally, the level of small and mid-cap exposure within the core portfolio. When applying this to your own portfolio, it's really important to be mindful of the typical level of small and mid-cap exposure within the existing core portfolio. Given the all-cap nature of thematic equity, we typically lower the upper limit of thematic equity where there's a high level of small and mid-cap exposure. Additionally, if the inclusion of a thematic equity increases the overall level of equity in a portfolio, that would also be a reason to lower the upper limit. Both of these factors typically result in a larger impact on standard deviation and tracking error. Limits on the maximum desired level of thematic exposure can help financial advisors establish a framework for including thematic equity across different market environments. While the level of thematic exposure may change over time, the narrative of disruption remains strong. Appropriately scaled exposures to thematic equity can be a vehicle for advisors to create memorable conversations with their clients. Importantly, this conversational alpha can help financial advisors and clients maintain focus on longer-term objectives, particularly while navigating more challenging market conditions.
Well, the biggest crisis of the year, if you want to call it a crisis, was the regional banking crisis that we saw several months ago. Silicon Valley Bank went under, and a lot of people attributed that, at least in part, to the surge in interest rates that we've seen over the past year and a half. More recently, we've seen a huge surge in the long end of the curve, the 10-year, the 30-year. They've been spiking significantly, close to 5%. Do you think that these levels in long-term interest rates could bring the risks in the banking system back to the forefront?
Certainly, there's a lot of focus in that area. And if we look at regional banks and banking sector as a whole, on their balance sheets, they still have a large amount of unrealized losses. And with the yield spike that we've seen during third quarter, and then also into the first part of October, there still will be a lot of pressure on those holdings within balance sheets. And so I would expect that we still will see a high level of unrealized losses. And that's something that investors certainly will be looking at as bank earnings come through during this earnings season. At the same time, the banking crisis is already in focus. And there's a lot more focus on the commercial real estate aspects. And those are all areas that investors are already looking for. What would be more alarming is areas that haven't yet come to the fore. And so that'll be more surprising because investors have had much more time to actually be passing through the information on banks' balance sheets and information from banks. So it's a less surprising space at the moment, but it is still an area that certainly is concerning. If you have any questions about how to include thematic equity or infrastructure investments into a broader portfolio, please feel free to reach out.
Now, I want to turn to a special guest, Tom Driscoll, who is the Director of Model Portfolio Sales at Global X ETFs. Tom, you heard the wonderful discussion we had today. Where can advisors go to learn more about Global X, as well as what we discussed today in this webinar?
Yeah, absolutely. And thank you very much for having me on. First, let's talk a little bit about, our product offering, our solution set. You can see our product suite provides differentiated exposures to thematic growth strategies, income strategies, commodities, and international markets. As of August 31st, we had over 50 billion AUM across 200 plus ETFs globally. And as you notice, we've designed our lineup to offer solutions that can help advisors navigate various market environments and allow them to use our products within various advisory business models. An example would be advisors using our ETFs within rep as PM programs, or advisors looking to scale out their practice and use our model portfolio solutions. You can see, focusing on our model portfolio solutions, we have 7 core and 6 model completion portfolios. We take a dynamic open architecture portfolio management approach with no strategist fee, meaning we're strategically oriented with the ability to make tactical tilts in our asset allocations and use Global X ETFs as well as third-party ETFs with no strategist fee. John and Michelle touched upon our flagship thematic equity strategy. We also have an alternative equity income completion model portfolio that's within that flagship completion suite that we have. These models provide differentiated exposures that can be combined with other core strategies. John and Michelle talked about how we work with advisors to scale these strategies into other core strategies or multi-asset class portfolios to provide more attractive, differentiated investment solutions for their clients. We support our relationships with macro research and portfolio commentary, allocation change reports, white papers, and education materials. And we publish these materials on an ad hoc, monthly, quarterly, semi, and annual frequency. So we are constantly communicating with our clients. We also have a team of investment consultants that are available to help support advisors at the local level within their respective regions across the country. And on our GlobalX website, we have an advisor login where financial professionals can access our information on the model portfolios via our advisor site login. And finally, our models are available on various third-party platforms as managed accounts, platforms such as GeoWealth, Envestnet, Merrill Lynch, LPL, Schwab, SmartX, and Orion.
Well, that's a great place to wrap it up. This was a fascinating discussion. John, Michelle, and Tom, thank you so much for sharing your insights with us.
Thank you.
Thank you.
And a big thank you to everyone tuning in today. A replay of this webinar will be available on demand in the Media Center section of the ETF.com website. Have a great day and see you next time.